In this video, we're going to talk about interest rates primarily. And I think we don't really need a definition of interest, right? It's the cost or the price of either lending money or needing money and gathering funds. One of the places we can look at for interest rates, a place that might be where many middle income investors and middle income families look to save some money, could be CDs, right? So a CD is an instrument used issued by a bank. There's a minimum investment interest rate, there's a maturity, just like most kinds of savings tools. And one of the places you can go is go to www.bankrate.com. When you get to that website, there is a link, there's a box, if you will, to click on, and that will take you to look at some CD rates. You can be very specific. You can look at CD rates in your area. So there will be some differences between banks, not a substantial difference, but if you can put your money somewhere, earning an extra 0.5% is maybe worth the inconvenience of not having that institution right in your backyard. What we want to kind of concentrate on for the next couple of slides, though, is what is an interest rate, right? How is it created? Well, if you look down below, we have a formula. An interest rate has two parts to it. It has what's referred to as a risk-free rate. And this is a rate of return that's guaranteed for a certain period of time. Now, technically, we can't find an interest-free rate, but we do have instruments that are interest-free. And from an investment perspective, we look to Treasury bills. Any United States Treasury security is, by definition, risk-free. The United States government won't default on its debt. So every interest rate starts with a risk-free return. Then we add to that a risk premium. Now, this risk premium is dependent on the institution or the company, if it's a loan of some sort that you're trying to borrow, or it could be the risk premium that's associated with a person if they want to borrow. So this risk premium varies based on the economy, based on the instrument, the amount of the loan, the length of the loan, the company or the individual's financial status that's borrowing the money. All of these things are associated then with the interest rate. And that's ultimately how we figure out a loan rate, right? The financial institutions, they're going to get money from somewhere to give to you. So in the end, we have this difference, if you will. So the impact of the economy on this risk premium is fairly significant. If economic conditions are weakening, right, firms that are issuing securities usually pay a little bit higher premium because there's a chance that they may end up in financial distress. So when times are getting worse, when the economy is getting worse, interest rates typically may go up a little bit because we're worried about risk. So investors are more willing to invest, right? They're more willing to give funds in an economic climate that is more favorable. So there's a little bit of a weird perception of this risk premium, though, right? Some investors are attracted to investments for the wrong reasons. They pursue risky investments to make up for limited income. This is a combination of a couple of things psychologically. One, the primary one, is the idea that we've talked about in some other videos, and this is my opinion, but it's consumerism, right? People are chasing returns, not considering the risk aspect of investing. And we'll talk about risk and return in later videos. The other issue that we have basically is, since people have maybe made some mistakes in the past and are feeling pressure that they want to retire, there's not enough money there, they may be trying to do, and I refer to this as they're trying to hit a home run, right? They're taking a very risky stance because they haven't planned well, and now they have to take this big risk, or they may not be able to retire or buy this thing that they want because of poor planning. So how do we ultimately compare interest rates and risks, right? The choice of how you invest your money is all based on risk, right? If you need your money within a year, you should take no risks, right? If you're going to need some of this portion of money in 2 or 3 years, then you can afford to take a little bit more risk. And of course, if you're 21, 22 years old and you're planning for retirement, of course, you can take a lot more risk because you have a lot more time for the market to do its thing, right? So there's no choice that we could say is right for all investors, right? You are going to choose based on your specific risk tolerance. Thinking about interest rates in general, right? The interest rates that we ultimately earn or pay, it's nice to know what if there is a pattern that you could look at, I guess. And what we're talking about here are Treasury bonds, or Treasury bills and Treasury bonds. There's something called the term structure of interest rates. This is a tabular illustration, if you will, of interest rates from United States Treasury securities with different maturities. And you can find one of these if you go to this website, the FINRA website here, and you scroll to the bottom, you will see a graph and a table that shows United States Treasury securities and their yields. The yield curve is the picture. And at the time of this video, there was an upward sloping curve. So what that means is short-term Treasury bonds and Treasury bills have lower rates of return than long-term Treasury bonds. So that's what we typically think should be true, right? It should be, you should get less return for investing or borrowing short-term than for long-term. So this curve, though, will change over time. It changes because of economics. It changes because of individuals' investing preferences. It can change because of the preferences of those people that want money, right? The net demanders of money. They don't have enough money. If they want a lot of short-term money, then those yields are ultimately going to be bid up because it's going to be cost more, right? You're going to want a higher rate of return than for long term. So the shape of this curve will change over time. And of course, loan rates will follow the yield curve. So every bank will have some schedule, if you will, of the interest rates that they charge or pay for various investments or loans. So basically here we have a CD rate, that's the red thing here, right? And we have an estimated 1-year loan rate. Well, the rate on individuals is higher than the rate that is paid out to these CDs. Why the difference in rates? Well, CDs are pretty much guaranteed, and what's the chance that this person that's borrowing money for a year won't pay? Again, there's a difference in the risk level, so the interest rates will be different. So what makes interest rates change are a couple of things. Primarily, one of the things that really changes interest rates directly and very quickly is what's referred to as monetary policy. The Federal Reserve controls the money supply. So they decide how much money is available for us to acquire. And the more money out there, the greater the supply, the lower the interest rate, and vice versa. The job of the Federal Reserve is to control inflation. So they will make changes to money supply. They will make changes to what's referred to as open market operations to manage the supply of funds so that they can control interest rates. And sometimes they do this and it makes sense, and sometimes it's kind of contrary to what certainly government and businesses might want them to do. But their job is to control supply, which ultimately controls interest rates. There are also some fiscal changes, right? The government has a demand for funds. So any change in the way the government needs money, their borrowing behavior, affects demand. Same thing for businesses. When firms adjust borrowing and spending, this affects the demand for interest rates. And of course, in the end, it's a supply-demand mechanism that ultimately determines the interest rates that we pay and the interest rates that we earn in the economy. So how does banking fit into financial plans? Well, the key decisions that you need to make is, number one, is what banking service things are important to you, right? What services do you want? And then in the end, what institution is going to provide the best services in a package? And there are a couple of websites that you can go out and visit that can give you some information about how you evaluate a bank, whether or not a bank will fulfill your needs or not. In the end, I think in general, most banks are very competitive. So you won't find dramatically different changes, if you will, in characteristics from bank A to bank B. Sometimes you use a bank because that's what mom and dad used. Sometimes you use a bank because the entity that pays your check uses that bank, and it's just much easier to get your money that way. So there's lots of reasons why you want to pick a bank. Again, these websites can give you some indications, right? Some patterns to follow, questions to ask, to figure out exactly which bank you would like to choose. I'll see you in the next video.